In the 50s, of course, the U.S. was a creditor nation. Now the U.S. is a debtor nation. Doesn't that change the equation a little bit in terms of being able to repeat what they did back then?
Yeah,
given the size of the debt load?
Of course, a bit. And you also have not the kind of growth you had in the 40s and 50s.
Yeah.
But as long as a country is owner of its own central bank and is able to print money, it never ever will be defaulting. We are not worried about the US being downgraded to BBB or CCC. The US will always repay their debt. The big question is, and that's certainly what you are relating to, what is the buying power and what is the value of this repayment for foreign holders of their bonds?
Yeah.
And that's clearly the issue we have to talk about. And foreign holders are always an interesting group to take grip upon, because they are not voting. You have to reallocate the burden from your voters to the owners of your debt being outside of your voter clientele. So you are absolutely right, but finally they won't have a default, they just will default on the value of the money.
Right now T-notes are yielding 2%, 30-year T-bond is something over 3%. Are those interest rates high enough to offset this risk that you're just describing? Or are T-bonds and T-notes maybe in a bubble?
Yeah, they are in a bubble if we just look on the economic fundamentals, but we are quite sure that we won't see higher rates going forward because the Fed is buying them. You will have enough pressure on institutional investors to invest in risk-free assets. And if you have capital market controls, your American citizens are not able to flee and also have to finally invest in T-bills and T-bonds. So we are not worried that the interest rates will move up. We rather expect that the interest rate will go even further, especially at the very long end of the yield curve, and Operation Twist clearly is focused on bringing the lower end of the yield curve even further down.
Okay, so to paraphrase, correct me if I'm wrong, you see T-notes and T-bonds really more as a trade while interest rates are falling, but not necessarily something that you would see as a long-term investment, because nominal dollars in the future will have less purchasing power than the dollars you're giving to the US government today. That 2% yield is not enough to offset that risk. Am I stating that correctly?
Yeah, you're absolutely right, and we even don't take it as a trade. Perhaps we are right in our assumption that the yields will come down a bit further on, but the risk of this trade in terms of buying power is much too high. Now we try, of course, to find pockets of investments which have a much higher probability to ensure buying power than T-bills and T-bonds will.
And finding that in the stock market?
Partially so.
Yeah.
There are very interesting quality stocks which we think are absolutely fairly priced. We don't find them in the banking industry. We expect a massive forced capital increase which will generate a lot of negative impact to the existing equity holders, and partially perhaps even to some bondholders, depending on their tier structure. We find that in equities with solid business models, which are ring-fenced against emerging market competitions with solid corporate governance structure, and the balance sheet situation which is well prepared for an inflationary scenario.
Yeah, you know, the stock market, you know, as they say, it's not a stock market, but a market of stocks. One of the observations that I've been making since the 2008 low after the Lehman collapse was how poorly the financial stocks have been doing relative to the market as a whole. which to me was sort of a red flag indicating that there's still problems in the banking system. I guess you would agree with that there's still problems that we have to face in the banking system.
Yeah, no doubts about that. We have gotten rid of all banking stocks in our portfolios in 2007, when we realized that the banking system is full of these very low regulated special purpose vehicles. And hardly any of the CFOs of a bank were able to give us a proper description about the real value of their balance sheet. We argued we can't invest in such structures. We have a trustee responsibility for the money of our clients, and the trustee responsibility is for us understanding the investment. And at that moment of time, we are not able to understand the business model of a bank, the quality of the balance sheet, and we argue that they need massive capital increases to regain a working and sustainable business model. And of course, if you need such a capital increase, the existing shareholders are the ones who have to take the blame.